Good morning and welcome to another Market Matters video update. My name is Harry Watts and I'm today joined by James Gerrish, our primary contributor. How are you, James?
Yeah, going well, Harry. Good to be here.
We're going to start with the big picture today before we delve into the stocks and sectors. So where do you see the US and the Australian market going?
It's a topical question. Obviously, we've had a big market drop start of February. We've now bounced back some of that, but volatility is clearly rising. I wrote in this morning's report just around, we're cautiously bullish at the moment. So, I think the rubber band has stretched further to the downside than it probably should. It's obviously been weighed by some of these more volatile tweets coming out of the US, etc. So, look, I think the market is bullish here. I think the market goes higher, but I think the biggest thing that we've got to be conscious of is that a rising volatility that we've seen in the last couple of months, there's probably a precursor to something more sinister down the track. So I don't think we're there yet, but I think it's a warning sign, a shot across the bow, if you like, for a bigger market move later in the year.
Sure thing. So market's heading higher short term. Let's start off with resources. Big portfolio weightings in both of our portfolios at the moment. What do you see going on there?
Yeah, I think resources are interesting here. So I guess bigger picture, we're sellers of strength rather than buyers of weakness in the resource space. The US dollar is weak. It was weak overnight. I think the US dollar is starting to find a low. So the US dollar index is trading between that 90 and 88 handle. A move down to 88. I think that's probably will do it for the downside move in the US dollar. So US dollar moving up overall in time will be a negative for resources. So right now, weakness in the US dollar is supporting resources. So I think higher prices in the near term, so short-term bullish resources, then medium-term bearish. So in terms of our holdings, we've got BHP, Rio in the platinum portfolio. We've got a holding in Fortescue in the income portfolio. So we're on the sell side in the strength. If you throw in energy in there, so we're probably more bullish on the energy space at the moment. So if you look at BHP versus Rio, more bullish BHP as opposed to the straight iron ore or nearly straight iron ore producer in Rio. Woodside we've got in the portfolio as well, so we're looking to sell that in the strength. That was positive yesterday. We might get, with the move in crude overnight, we might get the opportunity to sell into Woodside today. So short-term positive, medium-term negative.
Stay cautious. All right, moving on to the banks. They've been volatile of late. What do we see going on there?
Well, they've been weak of late, so you can put a few things down to it, whether it's the Royal Commission, whether it's rising short-term funding costs. The Aussie banks simply have a smell about them. I'm on the buy side of the banks here at this stage, so more of a shorter to medium term play than a longer term buy and hold play, but definitely on the buy side in terms of banks. If you look at, the sector now trades on 12.2 times, about 6.5% dividend yield. Seasonality, they're strong now. I know last month March is typically a strong month for the banks. That didn't play out. We've started to see buying in April. So look for strength, continued strength towards the back end of April. I'll then get a little bit cautious in May as the banks start going ex-dividend, but short-term higher prices for banks. If I had to take a pick of the banks at this stage, CBA has historically traded a big premium to the rest of the sector. The sector's now on 12.2 times, CBA's on 12.8 times. So that sector premium has really gone out of CBA, but the metrics of CBA are still a lot stronger than the rest of the other banking stocks in the sector. Their ROE is better, their internal dynamics are better. I know the Royal Commission's obviously been a hindrance to that, but the metrics are really strong. So CBA in the big four, and Bendigo actually looks cheap. We don't own it, but on 10 times that looks cheap as well, Harry.
Yeah, good stuff. All right, moving on, diversified financials. We've got a few holdings here and there. They've been weak. AMP especially there has been sold off. We don't own AMP, but what are your thoughts on the div fins? Yeah,
so look, if we've got a market view where the market goes higher short term, but overall our bigger picture viewers are in for a 20-25% correction in time, then diversified financials are not what you want to hold. So they're very leveraged to what the market does. We've gone for the cheaper stocks in the sector. As you made mention of, we don't own AMP. I'm thankful of that. I think that business model is well and truly done and dusted. We've got some of the cheaper ones in the sector. If I look at the area, the diversified financials on a global basis, the sector trades on about 15.5 times. We've targeted some of the cheaper ones. So Janus Henderson is trading on 11 times. We think it's cheap. Global manager, overseas earnings, etc. So look, we're feeling a little bit of pain on that position, but we'd be buyers here rather than sellers, but we are going to sell into strength. So the diversified financials Financials will track the market. They're leverage plays on the market. So if the market's strong, we're going to use that strength to sell our diversified financials holdings. If we've got the view, which we do, that we've got a bigger correction on the horizon.
Sure thing. You spoke briefly about Genus overseas earnings. What about some other companies? We hold Macquarie, we hold a few other companies that earn money overseas. What are your views there?
Yeah, Clydesdale, Macquarie. So Macquarie obviously fits in the diversified financials landscape. Remain bullish on Macquarie, but again, selling in the strength. 110 on Macquarie would be a really good price for us to exit that holding. Clydesdale, we wrote it in the report this week, where sellers above $6. So look, I still like Clydesdale, still like Macquarie. If we think the US dollar is going to base out at 88 and is going to start moving higher, then we should be looking to increase our exposure to overseas earnings. So it's a theme, for the rest of the year that we're going to be very conscious of.
Sure thing. And we bought the US dollar ETF in our Platinum portfolio recently. That's a big move into that space as well.
Yeah, we've only gone small, 3% holding. I mean, it is a cash weighting, so that's just holding cash but in US dollars. So look, I like that in the near term. If it goes lower, we'll add to it. So it's a cash holding. I think the US dollar is near a low, as I said. I think that has ramifications for broader sectors. But at the moment, we're just we're edging away, nibbling away at the US dollar.
Yield stocks, interest rates moving higher. We speak plenty about that. What are we looking at in the yield play?
Yeah, no interest there. So rising bond yields, anything that looks like a bond is priced off a bond is going to be negatively impacted by higher rates. We don't have any real interest there. I wrote about it in the income report a few weeks ago, just around the impact on, say, property stocks, for instance. Rising bond yields are going to be a negative there. So look, it's sort of swimming against the tide. You can do it, but it's hard work, and you've got to pick your right stocks or vehicles to go against the tide with. So for me, I'd just a simple avoid the sector for now, Harry.
Of course. All right, that's all from us here at Market Matters today. Thanks for joining us, James.
Thanks, Harry.
So.